Silver crashed 27% in a single day, and gold fell 12%. This is the biggest manipulation in history. If you're feeling like you've just taken a huge loss, the first thing to know is you are not alone. Millions of people around the world were holding positions in silver and gold. And what just happened is the biggest wealth transfer we've ever seen. The reasons behind it aren't what you think, like it's just some market volatility. No, this is complete manipulation. And today, I'm going to prove it to you. We'll discuss this crash that has shaken the entire market. Trillions of dollars vanished in just a few hours. If you took a position at the top in silver or gold, I can understand what you're going through right now. Gold fell from $5,600 down to its current levels. Silver, which was trading at $121, crashed all the way down to the $75 zone. People were calling for massive highs, but instead, we got this. Anyone calling this just volatility is lying. In this video, we'll talk in detail about the hidden forces behind this crash that the media isn't covering, and most importantly, what you should do now. This crash wasn't caused by just one reason, but a deadly combination of several factors. First, you have to understand the US dollar index, or DXY. This is a huge factor that most people ignore. Professional traders don't just look at gold and silver, they track the dollar index. There's an inverse relationship between the dollar and metals, like a seesaw. If one goes up, the other goes down. Today, the dollar index pumped extremely hard. When the dollar gets strong, metals go down. 90% of retail traders don't even know that they need to watch the DXY closely when trading metals. The second factor, the Federal Reserve gave hawkish signals. Hawkish means they plan to keep interest rates high. When interest rates are high, foreign investors buy dollars or bonds to get good returns. This increases demand for the dollar, which you saw happen in a big way. The DXY goes up, money flows out of gold and silver, and that's the pain we're seeing in the market. Third reason, China. China's industrial slowdown is becoming visible. Look, silver isn't just a precious metal like gold, it's also an industrial metal. It's used in electric vehicles, semiconductors, and solar panels. The latest data from China showed weak manufacturing numbers. When manufacturing slows down, investors assume that the demand for silver will also decrease, so the price corrects. This data was incredibly important. It's why gold corrected about 12 to 15%, but silver plunged around 27%. The industrial component makes it more vulnerable. Fourth reason, a partial US government shutdown began on January 31st. When there's political uncertainty, traders reduce risk and book their profits. This month, gold had already risen over 30%, and silver had pumped over 65%. So, people found an excuse to sell off and lock in those gains. But the biggest reason of all, and you need to understand this, is that the CME Group raised its margin requirements. This is the hidden cause behind silver's massive fall. In the last 6 weeks, the CME increased margin requirements 4 times. Raising margins means traders have to deposit more cash immediately, just to hold their positions. Let me explain it this way. Imagine you're renting a house for $25,000 a month. Suddenly, your landlord says, either you pay $50,000 starting tonight, or you get out. You'd be shocked, but you somehow pay. Next month, he comes back and demands $75,000. You'd think he's gone mad. He says pay up or get out. Then he raises it again. Ultimately, you'd have no choice but to leave the house. It's the same for traders. When margin requirements are hiked repeatedly, they eventually have to sell their positions or get liquidated because they don't have the cash. They become homeless in the market. And that's exactly what's happening. The CME in the international market and other exchanges globally are using these margin hikes. This is the same playbook that was used in 1980 and 2011 to crash the metals market. Now, let's get to part 2. The disconnect between paper silver and physical silver. A big magic trick is happening right now. On your screen, you see the price of silver crashing. But in the physical market, silver isn't even available. Mints around the world, like the Perth Mint in Australia, the US Mint, and the Royal Mint in the UK, have suspended sales. Either their stock is finished, or they can't deliver right now. In India, dealers are defaulting on deliveries. China has limited bullion purchases. The Shanghai vaults withdrew 27 tons of silver in a single day. China already has export restrictions. They're holding onto the metal, so what's happening? In the West, paper contracts are being sold to push the price down, but in the East, India, Russia, China. Physical delivery is not available. This is pure manipulation. This brings us to part 3, historical patterns. Will history repeat itself? Pay close attention. Silver showed a 65 to 70% gain this month. In the last 52 years, this has only happened twice before, in 1974 and 1979. Let's look at the 1979 scenario. Silver also fell sharply then. But if the same pattern repeats, silver should bounce back strongly in February. It could pump 35 to 40% again, possibly hitting $50 or even $100. But after that, they will likely dump it again, just like in 1979. In the 1974 scenario, silver went into consolidation for 5 years. The market moved sideways with volatility, but no new highs. So tell me in the comments, what do you think will happen? The 1974 outcome or the 1979 outcome? But what should you do right now? If you're caught in this volatility, follow these steps. First, if you own physical silver, do nothing. Physical metal is your insurance, not a short-term trade. Until you sell, your loss is only on paper. The fundamentals haven't changed. Silver is still in a supply deficit. However, if you're a leveraged trader, this is your wake-up call. Leverage in volatile markets is a death sentence. Reduce your positions, only keep as much risk as you can handle. And if you're a new investor, remember that when there's blood on the streets, smart money buys. But don't put all your money in at once. Use dollar-cost averaging and buy on the dips. In the international market, this area around $70 is a key demand zone for silver. I believe silver should bounce back from here. But if it breaks this level, a much bigger fall could come. Technically, though, we should see support form here. Don't see it falling and panic sell everything. That's how retail investors get trapped. The market takes money from emotional people and gives it to rational ones. If you panic and sell, you provide liquidity to the big institutions that want to buy at these lower levels. From my perspective, buying the dip is the best approach. You can buy gold and silver ETFs. You'll see a fall in their prices as soon as the market opens, reflecting this crash. That's your opportunity to buy at lower levels. You can even set up a systematic investment plan, or SIP, in these ETFs. To do that, you'll need a free DMAT account. I've put a link for a free DMAT account in the description and the pinned comment. One more thing. The crypto market is open on weekends. You can actually trade tokenized gold and silver there. On an exchange like Binance, you can search for XAG to find the silver contract, and XAU for gold. This allows you to capture market movements even when traditional markets are closed. If you need to hedge your positions, you can do that 24/7. The link for Binance is also in the description and pinned comment. Using my link gets you access to special airdrops and promotions. If you want a separate deep dive analysis on gold, comment gold below. Finally, the free DMAT account and Binance links are in the description and pinned comment. Open your accounts today. Share this video so people know the real reasons behind the gold and silver crash. Subscribe to the channel and click the bell icon. I'll see you in the next video. Until then, you go self-made and Jai Hind.